Good afternoon. Welcome to LBMA webinars. Today we are presenting Precious Metals Market Update, a very special webinar. We have Ross Norman, CEO of Metals Daily, as our host. And we have three lovely panelists. We have James Steele, the Chief Precious Metals Analyst at HSBC. We have Joni Teves, Precious Metals Strategist at UBS. And we have Suki Cooper, Executive Director of the Precious Metals Research at Standard Chartered. We are delighted to have this panel for you today. If you have any questions throughout the webinar, please submit them in the Q&A function at the bottom of your screen. We'll be taking questions at the end of the presentation. We look forward to receiving your questions. So Ross, I now hand over to you.
Taylor, thanks very much indeed for that introduction. And we're very privileged today to have arguably the three leading precious metals analysts and strategists in the world, no word of a lie. And so help me, if you will, by posing some good questions to them towards the end of this webinar. Over the next 30 to 40 minutes, we'll be looking at the past year and some of the key drivers for gold, looking ahead for the year ahead with and we'll be revealing the LBMA forecasts that have just been published today. And indeed, if you'd like a copy of that, you'll find that on the LBMA website and also on metalsdaily.com. You will also have your chance to have your say. We'll conduct a poll. Many of us met back in October and November, and you had your say. Let's see how your thinking has changed. But it's silver, which has been grabbing the headlines, up 20% in just 3 days before correcting lower with a social media squeeze. Now, what exactly is it that's driving the silver market? Suki, over to you. What is it about silver that's doing this sort of erratic behavior?
We've had a tremendous start to the year, and a lot of the driving force behind silver has been the investment demand. While for the bulk of last year, we saw a big increase in silver ETFs of over 8,000 tons for the full year, that momentum has continued in January. And we've also seen a continued build in retail interest as well. And it's been that surge in retail interest that has really driven silver prices, so much so that we saw prices testing an 8-year high on Monday. And the volumes that we've seen have been phenomenal. If we're looking at the silver ETFs, at the last day of January in the largest silver-backed ETF, SLV, we saw inflows of over 1,000 tons. That was followed up by a second day of 579 tons. And then the third day of 1,766 tons. These sort of volumes are incredibly strong and almost the equivalent of the full year inflows that we saw in 2019. So the volumes have been tremendous, but it's not just been the ETFs. If we're looking at coin sales, the US Mint reported for the first working day of February, sales of 1.57 million ounces. Around about 48 tons, and that is double the amount of coin sales that they reported for December. So the sheer volume of retail interest, of investor interest, has been very, very strong, driving silver prices higher. Part of it's been driven by some of the positive longer-term fundamentals for silver when it comes to solar panels and looking at some of the clean energy initiatives. But a lot of it has been driven by some of the positive momentum that we've seen in gold and investors wanting to piggyback off that at a lower price point.
Indeed, I mean, looking a bit of a spoiler alert at the LBMA analysts' forecasts for this year, they're expecting silver again to be the top performer with a gain of 38.7% year-on-year average. So silver, the top metal. You mentioned their physical. I looked just before we went online at a top US physical brokerage. They're charging over $41 for a silver eagle. That's close to a 50% premium over the spot price, reinforcing your idea, your comment there about the squeeze on the physical supply of these markets. Flow of demand has been phenomenal, and indeed the LBMA have reported record turnover in silver of 31, was it over 1 million ounces, isn't it, that they've been recording? That's equivalent to the entire global production. So again, the markets are hot, but the market's managing to cope with these massive flows. Jim, can you give us some thoughts on what's driven this particular? I mean, it's hot news now, has been this 20% gain in the last few days and the market correcting lower again. What's driving the flows behind that? Jim, you're on mute. You're on mute. Jim, you're on mute. Thank you.
Am I off? And am I off mute now, Ross? Thank you. Excuse me for that. Sorry, everybody. Some people prefer me on mute, but I think we have to ask firstly, why was silver targeted rather than the other precious metals? And I think it's because it does have the name recognition. It's much more cost effective than gold. And I think people understand silver in a way that possibly they might not platinum or palladium, and yet gold is too expensive. So it was sort of open to this. We do see, generally speaking, more retail interest in silver as a whole. I think the retail market, probably as a percentage compared to gold, is always higher. But these increases were quite phenomenal. But I think you have to draw a couple of comparisons. It was socially media driven, and it was similar to events that happened in select equities. But if you look at the depth and the liquidity of silver, it might be thinner than gold. And I think that's one of the other reasons it was targeted, but it's a lot deeper than the equities that were being pushed higher. And secondly, if you look at doesn't have a short position in the way that those other equities had. I mean, the gross shorts on the COMEX, 196 million ounces compared to 563 gross longs. So we were net long. So there was nothing for these buyers. There was no hunts for them. There was no shorts for them to hunt. And I think that's why we've begun to see the pullback.
And evidence for that, Jim, of course, is that there was no short covering rally as the market moved higher.
Yes.
It butted up against technical resistance at $30. There was no follow through buying. The argument is that they were fighting a battle that didn't exist.
I think that's a very fair comment and a very fair way to put it.
I mean, clearly, it needs to explain that London bullion banks and trading houses are typically long the physical and short the futures as a mechanism to borrow metal from the market in order to make the metal available to clients on a just-in-time basis. So any squeeze is actually not squeezing the market at all. All you're looking to do is the market's moving higher because you're buying it. Joni, from your perspective down there in Singapore, silver seems to be, I know that amongst the four of us, you are towards the more bullish end of a spectrum on silver. What's your perspective on silver on the year ahead? You're on mute, Joni. Sorry, just to interrupt you. You're on mute there again.
Are you back to me? I thought you said Joni.
Joni, she's on mute. Thank you.
It's me. I think you're contagious, Jim, with muting and unmuting. Yeah, so my view on silver very much is dependent on our view on gold. And to the extent that we're bullish on gold, I think that will spill over into silver. And silver does have the potential to outperform gold in this environment where industrial demand for silver is also expected to recover. I think silver has, even before the spike in prices that we've seen over the past week, I think investors have been friendlier to silver this year, given its industrial properties, and also as a way to trade the theme around environmentally oriented policies and how silver potentially can benefit from that. Not necessarily in our view that it impacts the demand for silver immediately. We think it's more of a medium to long-term theme. However, I think some investors like that theme and are already starting to trade on the back of that.
When you talk about green issues, of course, we're referring here to silver's use in photovoltaic cells. There is, I've had experience with dealing with some industrials. What they hate more than high prices is volatile prices. And of course, silver does run the risk, like the PGMs, that people will look for alternatives or thrifting if that continues to happen. Suki, I mean, I saw a wonderful headline. It was actually TD Securities who wrote it, which is essentially that they felt that the move in silver was the right thing, but the wrong timing. In other words, and that kind of reflects what we're seeing from the other analysts. Fundamentally, it seems that the professional market really rather likes silver. The reality is events haven't happened yet to authenticate a higher price. Would that be a fair assessment?
think that's been one of the most interesting developments in silver. Yes, that we've seen prices tested 8-year highs, and we do expect prices to trade above $30 per ounce this year. If we're looking at tactical positioning over the past year, we've actually seen the bulk of positioning being scaled back, but investors are slowly coming back into silver because they do have a positive view on silver and they do see more upside risk. And a lot of the positive momentum in terms of demand that might be driven by the solar panels is a much longer term story. We haven't seen some of the energy initiatives being discussed yet, and what sort of volumes we're likely to see behind this. But I think when it comes to the positioning that we've seen in silver, as Jim has already mentioned, the net short positions were actually quite light. If we're looking at positioning, whether it's from producers or whether it's from swap dealers or whether it's from managed money, short positions are actually lighter now than they were this time last year. So but I think what we've seen in terms of the phenomenal amount of retail interest that came through over the past few days is just how liquid the silver market is, just how deep the silver market is, and the fact that it's a well-supplied market. So if we're looking at silver just from a supply and demand point of view, it is a well-supplied market. There's more than a year's worth of inventory, whether we're looking at LBMA stocks, which was reported earlier this year at record levels, or COMEX stocks at 12.4 thousand tons, was also at a record high, or whether we're looking at metal held across the physically backed ETFs at over 30,000 tons. So all these together provide for a very liquid market. But I think what we could see is some tightness in the near term if some of the retail inventory has started to run low. But overall, the market dynamics continue to be supported, whether we're looking at the positive backdrop created by gold, or whether we're looking at the fact that we're starting to see some positive developments in the longer term story for silver. So yes, I think it is fair to say that most of the risk for silver is skewed to the upside. Not to say that prices won't be volatile. The higher level of retail interest, I think, suggests that we could see more volatility in silver compared to the other precious metals. But silver looks very well supported for this year.
Thank you. You touched on gold then. Let's move on to gold. Jim, March last year, the gold-silver ratio hit, I'm told, a 4,000-year high, 128, as silver struggled. Of course, it then caught up. We had a 48% gain in silver, most of it in the second half of last year. Silver caught up. And with the recent rise in silver prices, as we saw in the last few days, the ratio effectively fell to 62, roughly halving from March last year, telling you about the outperformance of silver. Now, as a group, I've been looking at the LBMA forecasts. I know you're bullish, but you're probably the least bullish in the room of all of us. What's your outlook for the market?
Well, we are positive, and I think it's a question of relative bullishness. We did see a phenomenal ETF demand last year. It's on 40 million ounces. I mean, it's absolutely incredible, up from 81.5 to a high of almost 112 million. I mean, absolutely spectacular, 30 million ounces. It's absolutely spectacular amount. It's going to be hard, I think. And if you look at the relationship between price and ETF accumulation, it's very, very close. I mean, the R squared is very close. It's like almost 0.9. So there's a strong correlation between movements in ETF gold and the price. And if we don't get, and I think it's plausible to say that we're unlikely to get a record level of ETF buying again this year. I think there's very good reasons. We're positive on the market. I think we will see further ETF accumulation, but it might not be of the level that we saw last year. The phenomenon of the COVID crisis, the quantitative easing, the fiscal, all of this was very new in the first half of last year. And it's not to say that we're not continuing to face problems. We do have further quantitative easing is going to continue. Easy monetary policies, the Fed have made it quite clear, are going to stretch into 2022. Other central banks have said similar things. We have a lot of fiscal spending, but it's not necessarily news to the market. So we see it as being highly supportive, but it's questionable whether it can really push the market very sharply higher. We saw just with modest tapering comments, which were proved to be premature, early in the month that the gold market retreated quite quickly. So we have to be aware that the gold market might not even move with changes in Fed funds, but even on a hint of tapering, even though that tapering clearly won't come anytime soon. Yeah, but we simply have enough there, I think, to keep the market well supported. But how much higher is questionable.
When we all last met back in November, just post-election, I sensed, and I was one too, that we were particularly bullish. I sensed, Jim, that your position has pulled back a little. We had the blue wave, which we all agreed was possibly the most bullish outcome. My sense is you're positive, but a little less so than you were back some months ago. Would that be fair?
Very modestly, not much of a difference, but just very slightly. And I think part of that is the vaccine, or a large element of that is the rollout of the vaccines, which appear to be having different successes as we look, and it's a moving target, of course, but the further out you go, I mean, the more successful they're likely to be, and the more likely we are to come back to some level of normalcy, which I think is going to reduce at the upper end the safe haven and the quality asset buying of gold. Not going to obviate it entirely, but it's just going to reduce it, and that's all we have to do. And I think it's easy to forget that historically, these are still very high prices.
Indeed, Suki, I remember when we spoke in November, the point that you stressed, and I think Jim supported you, was US dollar. I mean, I think many of your organizations were US dollar negative, and perhaps taking the shine off gold this year, especially, has been a relatively firm dollar. Do you still maintain your position on the dollar and therefore strong position on gold?
We do still think that the bearish trend for the dollar is likely to resume, given the blue sweep that we've seen. Yes, we're now expecting greater fiscal spending, and we're likely to see less constrained partisan politics, and yields have ticked higher. But inflation expectations have ticked higher as well, and we still expect real yields to remain low or negative. And in terms of the US's interest rate advantage, that has dissipated. And also, if we're looking at the US current account deficit, budget deficit, that still is expected to deteriorate. So overall, we still see a downtrend for the dollar resuming, but in the near term, we could see periods of consolidation or bouts of strength as well. And the correlation for gold at the moment, the strongest correlation is still the dollar. It's running at 50% on a 3-month rolling correlation. So the strength that we've seen in the dollar so far this year has weighed on gold significantly, but the macro environment hasn't changed substantially. We would argue that we're actually in a weaker position now than we were at the start of 2020, given that the policy cupboard looks relatively bare. We've got larger debts. So we're at a position where we have seen the bulk of the allocation into gold already, given the ETF flows that we've seen, and that is expected to moderate. But I think the key drivers still look positive in terms of monetary policy, in terms of fiscal policy, and perhaps what will be a little bit more important for gold this year is inflation expectations and whether we start to see inflation build.
Indeed. Taylor, could we have the next slide, if you wouldn't mind? On there, you'll see the forecast of the four of us for this year as submitted to the LBMA. The two on the right, Joni Teves and myself, being more bullish than the two on the left, Jim and Suki, but we're all remaining positive for gold. The table down the bottom on the right-hand side there, you'll see the expected change in the gold price year-on-year average. Only 1770 average last year, but 11% gain. Silver, as I mentioned earlier, the top favorite on price performance, but again, on a year-to-date basis, only a modest gain of about 8% expected from those levels. One of the issues looking at gold that we saw, Joni, last year was with 2 years of successive strong prices, 19% in 2019, 25% last year, is that some of those price-sensitive markets in Asia rather struggled with that. What are you seeing in Singapore at these higher elevated prices? Is demand coming back in Asia?
towards the end of the last year, conditions have started to improve in terms of physical gold demand, and we expect that recovery to continue for the rest of 2021. So to highlight, in India, imports in Q4 were up 9% year on year. In China, onshore prices have moved back to a premium, although looking at import volumes, those remain muted, and trading volumes on the Shanghai Gold Exchange are also still muted, but I think there are indications that the recovery is underway there as well. We've done some work recently, and some of the results show that there is a strong positive relationship between consumer physical gold demand and wealth measures. So specifically, jewelry demand is positively related to GDP, and bar and coin demand is positively related to savings. So as incomes improve, this should also support physical gold demand. And in turn, I think healthier physical markets should act as a cushion for gold prices this year, especially during times when macro factors exert downward pressure on the price.
Indeed, Taylor, could we have Joni's the next slide, if you wouldn't mind, on that? There we go. That I think that exemplifies it. Indeed, we've seen, Joni, haven't we, discounts, massive discounts in Loco Shanghai last year, records. I think it was down to $70 discounts. In India, again, significant discounts. Those discounts have effectively eased, haven't they, as the price has settled at these levels. One senses, Joni, that the markets in Asia are now used to these higher prices. And would I be right in saying that it's providing a good floor under the market? It's not going to chase it higher, but it's going to provide a floor. Is that your sense as well?
Yeah, definitely. I think initially the higher prices would act to dampen demand, but eventually there's some sort of acclimatization to the higher price levels, and a lot of the physical interest is ingrained in culture and traditions, so that type of demand tends to be quite resilient over time.
Suki, one of the key issues, and if I can have the next slide again, Taylor, one of the key markets, of course, remains India, and they've been plagued with massively high taxes out there, and they've reduced them. But it's not as simple as that, is it? Can you run us through what's happening in India?
The news this week from the budget was actually a positive development for the gold market. But given the volatility that we've seen in the silver market, it's been somewhat overshadowed. So I would argue that the physical market is one of the weak points in terms of the gold outlook. And the fact that investment demand had such a large gap to plug last year. So going into this year, I think the physical market is going to be important in terms of providing the floor, the cushion for gold prices. And in India and China, where we saw a most significant drop, we started to see demand starting to stabilize over the back end of 2020. And so far in 2021, we've started to see some appetite returning. But for India, one of the challenges has been that not only has the market suffered with high prices, and we saw this weighing on gold demand even before COVID was declared a global pandemic, but also the fact that gold was attracting less interest on a general retail basis. So the fact that in the budget on Monday that we had an announcement that the duty was going to be cut, I think is very supportive. Partially it will help to alleviate some of the unofficial trade that's going into India, but also I think it'll help in terms of consumer interest returning. But also it's important to note that as the duty had risen, gold prices in local terms started firming as well, and we're trading above 50,000 rupees per 10 grams. And those sort of price levels were a psychological hurdle in terms of India's consumption. Now we've got the combination of local prices falling again, we're below that 50,000 mark, and also the cut in duty, I think should create quite a positive backdrop. But in addition to this, the budget that was announced by the finance minister on Monday is very supportive for economic growth. It's a pro-growth budget over the next 5-year plan, and it's an expenditure-led budget as well. So I think that will create a much more favorable backdrop in terms of retail consumption, but the cut in duty, which has previously weighed on gold imports. If we go back to 2012, 2013, when the Indian government switched from a fixed rupee rate, started increasing import duty, India was importing over 1,000 tons per year. Last year, it was less than 400 tons, so it's fallen quite substantially. But from our data, we can see that's the lowest terms of imports in probably about 20 years. So we think that this should help to support some of the imports and some of the underlying consumption to provide a better floor for gold prices.
Of course, a lot of that decline in Indian demand, Jim, was taken up, the slack was taken up by ETF demand, investor demand in the West. The market almost pivoted, didn't it, from being a very Asian-centric thing to a Western investor thing. Central banks buying, ETF buying. You mentioned there earlier on that the ETF buying was a record. Indeed, the record was in the first 6 months of the year. It beat previous full years. I guess what worries me, and I'm supporting your argument here, is that many of those drivers seem to have waned. Momentum seemed to have come out of the market, supporting your slightly lower bullish forecast, if you like. Some of the oomph seems to come out of the gold market, doesn't it? Am I right in that?
Well, I think that's right. And you know, Joni and Suki were bringing up some really great points. And I agree that even if we expect a modest recovery in jewelry demand this year, but still well below what the highs have been just even a few years ago. And if you look at it's almost simple arithmetic. It's not even math. If you look at the decline in many of the physical markets and the increase in ETF demand, they pretty neatly meet each other. So if we don't have this level of ETF demand that we had last year, which we don't think will be the case, then this has to be absorbed by the physical market. And if we don't get a more rapid recovery in jewelry and demand, it's going to be slightly negative. But not greatly, because we still have a monetary and fiscal support for the market, and the match between real yields, and we took the 10-year and it's inverted there in real terms, minus inflation, against the gold price, and it fits very closely. And Steve Major, our fixed income analyst, is still looking for between 50 and 100 basis points, 75 mid-range by the end of this year, and into 2022. So even if inflation does not gallop away, we're still going to get negative rates, and that's going to be key in supporting the market. But again, it's a question of keeping us high rather than charging up, because as was just touched on, you look at the imports into China, you look at the imports into India, it's over 50% of physical demand, and they are down. And even if we get, in percentage terms, a decent recovery, they're still going to be historically weak and can't be made up by coin and bar demand.
Interesting. Supporting your argument, Jim, analysts were asked to comment on what they felt the key driver was, and it chimes with what you're saying there. Negative key.
Yeah, the last thing I would mention very quickly, sorry, which I forgot, Ross, was the decline in central bank appetite. 657 tons in 2019, significantly lower last year. There's a lot of reasons for that: the decline in trade, reduced current account surpluses in some of the buyer countries, and the lower price of oil. Some of those things are coming back, so maybe we'll see a bit more of a recovery in central bank demand this year, which would help. But that's also a couple of 100 tons, that the market has to absorb.
Joni, you and I sit at the more bullish end of the spectrum in the room at the moment. How do you feel? I mean, I take the point that the Asian demand is nicely supporting the market. It's well supported. There's a floor in there. Are you concerned that ETF demand and central bank demand may be waning? Could the market be looking to flatline for the rest of the year?
So we have been bullish on gold for some time, and we reiterated our view when we published our broader outlook towards the end of last year. And the thinking here is that gold continues to have a place in investor portfolios as a diversifier, given, as Jim discussed, a commoditative monetary policy, negative real rates, a weaker dollar, and continued uncertainty. I think the reflation theme with prospects of large fiscal stimulus holds upside risk to the extent that inflation concerns also pick up and compress real rates. And I think one key factor really last year was the broadening of gold's investor base as well. We think that even though we have seen a lot of inflow and a lot of allocations into gold last year, we think that there is room for that trend to continue into this year, because it wasn't so much a case that a few investors put in large positions in gold. I think there was also a broadening. So those that were previously not really involved in the gold market saw it as a good addition to their portfolio as a diversifier and a hedge against risk. So that's basically kind of where we are thinking. That said, since we have published our outlook, which is also what is being reflected in the LBMA survey, the downside risks have clearly increased. A key challenge for gold, in our view, is that if we get persistently strong data, potentially brought about by positive developments on the vaccine and the vaccine rollout, the fiscal stimulus that's going to be introduced, and all of this brings forward Fed policy normalization expectations. And in general, a much more optimistic macroeconomic backdrop does diminish gold's appeal, and the potential for real rates to move higher and eventually maybe move back into positive territory does raise the concern of holding gold becoming more expensive again.
Great, thank you, Joni. We're going to move on to platinum in a second, but if I can ask Taylor to ask you your views, just to remind you, back in October, when we convened, we asked you what you thought gold would do. You, as a group, suggested gold would be somewhere around the 1965 level. Post-election, we asked you again, and you went very bullish as a group. You were north of 2000. Where are you now? You should have a pop-up in front of you. So where do you think gold will end the trading year of 2021? If you could enter your expectations, that would be wonderful. I can't vote. Okay. We can't vote, Jim.
I was just trying to make out the numbers here with this failing vision of mine, Ross, along with my mental faculties.
Taylor, do we get the answers?
We're just waiting on a few more people to give their responses.
Okay.
Interesting responses so far, I can tell you that. I might wait another 30 seconds.
While we're waiting, what I'll share with you, you will have the LBMA forecast there. We'll be moving on to platinum, which is the second most popular expectation to move higher in 2021. Platinum has underperformed its sister metals, palladium, and not least of all rhodium. Suki will be looking at that in just a second, and we've got some questions to answer as well. A good number of questions.
All right, I'm going to end the poll and share the results.
Right, well, it looks pretty evenly spread across the top four. If I had to make a calculation, I would suggest that the average is somewhere around 1950, in that maybe a shade lower than that, low 1900s. What that suggests to me is you've reversed as a group, even lower than you were back in October and November. I don't have an exact average for the entire group, but the 2000s, which were 24% of you, is well down. So, oh, sorry, I'm misreading this, aren't I, actually? The red is the top group, isn't it? It's 27%. So I'm sorry. You're roughly in line with where you were last time. Rewind on that. The largest share being north of 2000. So you're not persuaded by our slightly less bullish views. You remain very firmly bullish on your views on gold as an audience. Thank you very much, Taylor, for that. Misread that. Let's go back, if we may, Suki, to platinum. It's been lackluster compared to palladium, and rhodium has had a Bitcoin experience. You take a fairly positive view of platinum, don't you?
Yes, I think for the bulk of this year, we're likely to see the industrially biased precious metals faring better than gold. But it's important to know that yesterday's laggard is not necessarily going to be tomorrow's leader. But we do think, given the move towards looking at green initiatives, clean technology, that we're likely to see metals like silver and platinum starting to fare well. And we've seen over the course of the past year, and certainly in terms of ETF flows, that view is being supported by longer term investors as well. So I think with platinum, it's likely to be a rocky road. We have had a strong start to the year, given some of the supply losses, the unexpected supply losses that we saw at the end of Q4. But also, I think, given that the vaccine rollout has been initially very slow to start with, presents a somewhat of a fragile recovery when it comes to auto demand, when it comes to jewelry demand. But we do expect demand to eventually improve as the year unfolds. And we think the balance is likely to be tighter at the end of the year than it is right now. So we think there's downside risk in the near term. But we think as the year unfolds, we're likely to see some of these bigger themes coming to the forefront. One of my main concerns with platinum is that there is a lot of interest in platinum on a longer term basis at the moment. And as we saw through 2020, that ETF interest can be a source of demand, but it can also be a source of supply. But some of those longer term themes for platinum are positive in terms of eventual substitution between platinum and palladium when it comes to auto consumption and the hydrogen economy as well. But we don't think that these are necessarily dynamics that are going to unfold to reveal substantial increase in platinum demand imminently for the market through the course of this year. But we do think towards the end of the year, some of these supportive demand trends are likely to provide a much more solid floor for the platinum market, and then build a base for platinum to start to rise further throughout the next few years. But I think in the next quarter or so, it's going to be a little bit more fragile.
Certainly, we've seen platinum enduring 5 years now of deficits, precisely the sort of environment we saw in palladium pre-rally, and that could indeed tighten the market quite considerably. You saw a note just there. Please do fire your questions across. Anything, Jim or Joni, that you'd like to add on platinum?
I think that
I guess
we're going to see, we might swing into more of a surplus this year, is our view, and we would base that off of the combination of increased supply, mostly from South Africa, but also if the ETFs don't keep up quite the same pace. I mean, if you don't have substantial buying in ETFs for platinum, you'll swing into surplus more significantly. That is not the case for palladium. It's the opposite for palladium, where we're still going to see a structural supply-demand deficit, but we have a surplus in the platinum. And I agree with everything that Suki said, but some of it might need to be pushed, as she stated, further out from this year, particularly the substitution issue. It's got a good future, but I think right now it's still burdened with and will be burdened with supply, which will have to be absorbed by the investment community. And if we get any diminution in the gold rally, then that might sop a little bit of energy out of the platinum.
I guess the big unknown remains Eskom and power supply to the key South African mines. That can change quite dramatically. I know that South Africa's had problems in that space. Joni, you're about to give your thoughts on platinum?
Yeah, I was actually going to agree with Jim as well in flagging the potential for supply risks to create headwinds or supply growth to create headwinds for platinum this year. We are expecting a 31% increase in mine production, and this contributes to an overall increase in supply of about 22%, including scrap. So this means that investment will have to kind of absorb that growth in supply.
Excellent. Thank you very much indeed.
I mean, the auto demand is going to be strong, but it's not going to be as strong as the palladium. And as Joni said, I mean, the whole recycling issue is very important for platinum.
Excellent. Thank you. I guess in trying to summarize what we think, correct me if I'm wrong, we remain bullish on all precious metals. As a market, clearly silver is our favorite. I would say we remain bullish, but perhaps a shade less than we were when we last convened back in November. We've had the most bullish expectations politically. but questions still remain in the economy. Stimulus is yet to be agreed, the fiscal stimulus, etc. So in short, we're bullish, but perhaps a shade less so. If I may, before concluding, address one or two of the questions. We've got a record number of questions coming through, so my apologies if we don't get to answer all of them. Just to pick on one or two. Let's have a look. What percent of investment do you think is for the longer term clean economies? Is fuel cell and hydrogen's at least 5 years away? I guess this is in reference to platinum. What percent of investment do you think is longer term clean economies? Fuel cells and hydrogen. Who fancies that one on platinum? Do we think this is, expectations of hydrogen economy, or is it investment? How do we think?
I think given a lot of the positive rhetoric that we've heard around hydrogen economy and the timing of some of the ETF inflows, I think a lot of it is longer term interest in platinum, but also it was, given that it was the laggard across the complex, its price point was relatively low, it has underperformed. I think it's seen as a strategic allocation. So I don't think, actually, I think there was a combination. In the fourth quarter, it was a combination of some of the supply losses that we saw coming online. But I think a bulk of the interest that we've seen in platinum is probably longer term. And the reason I say this is because when back in March 2020, when COVID was declared a global pandemic, we saw a quick net redemption in terms of the platinum flows, and that was and that probably spiraled a little bit faster than we saw the net redemptions materializing across the other precious metals. So I think we've already started seeing some of that longer term interest, and because these imminent hurdles materialize for the platinum market, those redemptions appeared as well. So I think generally it is a longer term story. I think there are still headwinds in the near term. But we've not only seen an increase in terms of ETF flows, it has been on the retail side as well, in terms of coin sales, in terms of tactical positioning, it's started to turn positive as well. But I do think that the recovery is going to be a little bit fragile.
Lovely. We're over the 40-minute level. There's one quick question which I'll answer if you like. How much silver do you think is in above ground stocks? The LBMA reports 34,000 tonnes and COMEX 12,000 tonnes, which is 46,000 tonnes. So that's about a year and a half's worth of mine production or demand. So the stocks are there. It only leaves
there's always more around than is visible. It might not be deliverable, but there's a great deal above ground.
Unreported stock, so certainly a year and a half, perhaps more than that. It only leaves me to thank our speakers for giving up their time. You've been very kind. Thank you. Thank you for joining us. And back to you, Taylor.
Thank you very much, Ross, Joni, Jim, and Suki for joining us. We really appreciate it as always, and we had a lot from you. Just some housekeeping from me. We have a few webinars coming up. As you can see on your screen, next week we will talk more in depth about the price forecast review. So we have a wonderful list of speakers coming up. They're escaping me now, but they will be available to you. And coming up after that, we do have Chinese gold market in the year of the ox. So we welcome back Joni on that webinar. And we'll just see the gold flows focusing around the Chinese gold, Chinese New Year. And then following that, we'll have the highlights of our 9th Assaying and Refining Conference. This year will be digital, so that will be a pre-recorded webinar as well. We hope you can join us for those. We've added in another section to this webinar, which is about our upcoming events. So our member event annual party for this year is cancelled, as you may imagine. Following that, we do have our Assaying and Refining Digital Conference on the 15th to the 17th of March, and then our members annual general meeting on the 1st of July. Our conference in Lisbon, in sunny Lisbon, where we'll all go and we'll have a nice cocktail on the beach in the sunshine, and that is the 19th to the 21st of September. And then our members dinner in December on the 1st. So these are the upcoming events for the year. We hope that you can join us. And thank you very much for joining us today. Have a lovely afternoon and a lovely rest of the week. So again, thank you to our speakers. Thank you for joining.